Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address rshaw@fxcm.com. Anyone wants to send an email, that's the email to do it. I know there's a few outstanding. I will get to them. I'm begging your pardon. Today is Tuesday. It's the 12th of July, 2022. Just going to bring up our high risk investment warning. I'm going to keep this on screen for a few moments, and then we'll move on to the commentaries disclaimer. And yes, our references: FXCM Markets 2.0, CNBC.com, and TradingView. Let's just bring up the yield curve. It's gone deeper into inversion here, so we just want to keep an eye on that, because you know, an inversion of a few basis points for a few days, I don't think that's particularly worrying. But the longer it stays inverted, the more serious it becomes, because it actually I think would change participant behavior. I'm just going to go through to our CNBC market note, and it reads: European markets head for another negative open as investors await inflation data. So that inflation data out is tomorrow. It's actually forecast to be higher, which is unbelievable, but we'll see how it we'll see what the print is. European stocks are expected to open lower on Tuesday as investors gear up for the last US inflation reading on Wednesday. Sorry, for the latest US inflation reading on Wednesday. The lower open for European stocks comes after a gloomy trading session at the start of the week, with markets closing lower Monday as investors prepare for more key inflation data out of the US this week. The June consumer price index is expected to show headline inflation, including food and energy, rising above May's 8.6% level, which I think is quite incredible. Market participants have been reflecting on a stronger than expected jobs report out of the US last Friday, which showed that the economic downturn worrying investors has not yet arrived. The jobs report, while good for the economy, could embolden the Federal Reserve to continue its aggressive rate hikes in the coming months to fight persistently high inflation. And I think that's exactly why we're getting the inversion here. It will be tested with a slew of US earnings for major banks, and the latest consumer inflation reading coming up this week. So Q2 earnings. So the earnings for Q2 are coming out, starting off with the banks. I think that's going to be very interesting, because they generally set the tone in terms of their forward guidance. So we'll keep an eye on that. There's no major earnings releases in Europe on Tuesday. Data releases include the ZEW Economic Sentiment Index for July from Germany. All right. Just take a look at some of the charts, see what's going on here. I'm going to actually bring up the US dollar underneath this. Okay, so take a look. This is really interesting. Let's make this logarithmic. All right, this is really interesting. I think just in terms of here's sort of where we inverted first, and you can see something interesting. So we're going back to April, and hold for me 1 second. Hey Gladys, can you take the call in the boardroom? Gladys, can you take the call in the boardroom, please? Sorry about that. Okay. 7Z. All right, I'm just bringing up my trading station, which I didn't log into. But all right, here is our inversion. Okay, here is our inversion. Let's take a look at the gradient of the dollar before the inversion. Okay, just take a look at this. And it's just asking for this EMA here. This EMA, we can actually take it out. It's not really, it wasn't really used for this chart. I use this on a monthly chart. So let's just take that out, and we don't really need that. Hey, Katie, morning to you. All right, so we've got the gradient here. Watch this. Okay, gradient 1, which is gradient 2. Okay, so that was pretty flat. Certainly, when I say flat, the blue is obviously steeper than the red. And then when we get the inversion, we get a real acceleration in the dollar. That's interesting, isn't it? Make this one. Make this one black. Okay. All right. So that's something that I think is interesting. But there's another dimension to this. What we can do is, instead of looking at it in terms of the inversion, okay, let's go back to that real rate. So US 10-year minus break even. Okay, same exercise here. Okay, so we've got an inversion and we've got real rates moving positive, and I think those together probably have a fair amount to do with the steepening of the trend line from red to blue to black. So what does it mean for us as traders? Well, I think for us as traders, it means as long as the real rates continue to push up, and as long as the inversion, okay, threatens recession, we probably have a very good reason to call the US dollar a safe haven. The real rates that have gone positive would be obviously a huge magnet for capital, given the inversion. See how they work together? So the inversion suggesting recession. Well, we're always kind of looking into the future. So now we're thinking to ourselves, well, wait a second. If there is chance of recession, where's the safest place to put my money? Wait, the real rate, that's positive. It's not a great return at all, but it's inflation beating. Now, when I say it's inflation beating, we've got to be very careful with that. It's inflation beating according to the break-even curve. Okay, according to the break-even. In terms of sort of headline inflation, it's behind. Okay, there's no ways it would be in front of that. But the idea here is you take what you can get. So the inversion, let's go back to that inversion. Okay, the inversion is now serious stuff, because it's not letting up. It's not letting up. Okay, so that's a problem. It's a problem because if it's not letting up, we want to know, well, why is it not letting up? And I think the reason it's not letting up, we can go to the Friday's non-farm payroll report. I think there are hidden sort of covert weaknesses there, but face value, there's nothing that's going to sort of outright tell the Fed to slow down in terms of their aggressiveness. And that suggests to me further inversion. What's going to be very interesting is the inflation number this week, tomorrow. That's the next part of the jigsaw puzzle. If it does come up, if it does beat that 8.6% that we saw last month, possibly 75 in September, starts getting priced in. Well, that feeds into this inversion. If that feeds into that inversion, okay, given that there are real rates that are positive, I think the dollar remains a fair play at the moment. Okay. Just see, and so short-term US government bonds. Just elaborate on that question, Anna. Are you asking if we should short US government bonds, or if the movement is in the short-term government bonds? Put your cash in there. So obviously, I can't say you should put your cash in there. I can't give advice. What I can say, of course, is that it's probably caught the eye of many portfolio managers out there, because ultimately you're getting, that's right, yeah, you're getting a return. So what we're effectively looking at here, so Anna, that last statement says, the last thing Anna writes, you're getting a return. That's actually the key. That's the key. And we're going to do some analysis in a moment, but you're getting a return. But let's just bring up Microsoft Paint here for a moment. Okay, so there is obviously a risk reward tension. Okay, there's a risk reward tension in the markets. We obviously want to earn reward. We obviously want to earn reward that is appropriate for the amount of risk that we're taking. Okay, I think we all get that. Where it gets slightly confusing is, where does that adjustment take place? Where does that adjustment take place? And the adjustment always will take place in price, always. Okay. And that could be any price. So in the interest rate market, the price would be yield. Yield is a price. It's the price of money. In the stock market, it's the price of the equity. Now, how does that adjustment? So here's the question: how does this adjustment work? Think about it. Now, let's have a scenario: risk is increasing. Risk is increasing. Okay, this is where, when I first sort of read through this, I had to read through it a few times just to get my head around it. So I just want to stress: just pay attention, ask questions if sort of doesn't sort of make sense the first time. Risk is increasing. Okay, if risk is increasing, okay, we want more return for our risky investment. I think we all get that. Okay, we all get that. We want more return for our risky investment. So those two points, I think, are straightforward. But now we want to just remember the adjustment takes place in the price. In order for us to get more return, in order for us to get more return, we actually want to buy things cheaper. Does that make sense? Think about it. We want to buy cheaper because the best way to perhaps think about this is in terms of a high growth stock. Just let's call it stock X. Okay, and we'll say that it's trading at, let's just call it $100. Okay, stock X trading at $100. Okay, now we want to monitor the risk associated with putting our money into stock X. So if the risk increases, we will need more from stock X. How does that adjust? We'll be willing to buy it if price declines, say, to 80. That's where the adjustment takes place. Prices adjust for the risk to reward. Because everyone, it's a little bit tricky, but if so somebody comes to you with a business opportunity and they say, will you invest in my business? And you make an assessment for the risk and you say, based on my assessment, the risk is high, what you're asking for is too much. I will give you less based on the risk because it doesn't pay me otherwise. See that adjustment? So that's exactly what's happening here. Investor behavior is changing. This over here, let's just tie it together with the inversion. Let's tie it together with the inversion. This whole paradigm that we've spoken about, is all about risk. If there is an inversion, what's happening to risk? See what's happening to risk, okay? There is a good chance risk is increasing, okay? Good chance risk is increasing. Good chance, why is this not like? Good chance risk is increasing. If there is a good chance risk is increasing, okay, we want reward to match, okay? Where is that adjustment going to take place? Prices need to adjust. Okay, so that's what the inversion is telling us at the moment. Okay, so if prices need to adjust for us to be enticed into taking the risk, and we feel that the price has not adjusted enough, then we're going to look where is an appropriate place to put our money. It seems that the market is giving us a clear indication that the dollar is the current place to be, considering the risk-reward trade-off, because prices may not have adjusted. You guys with me on that? You guys with me on that? Just let me know. It's a little bit. Okay, good. So that then brings us to our analysis. Okay, so what we can do here is take a look, say DAX. Okay, now what's happening here? Here is the US dollar at the bottom. Here's the US dollar at the bottom. Okay, here's the DAX. Look at this. Okay, so now there is a inversion between trend of DAX, trend of dollar. Now, how do we square up? How do we square up the fact that there's 3 trend line shifts in the dollar, no trend line shifts in the DAX? How do we square that up? Well, it's not that there haven't been shifts in the trend line in the DAX, it's that the DAX trend has changed as the behavior of market participants has changed. So whilst we got the shift up in the dollar, okay, market participants kind of saw, wait a second, we're getting close to an inversion, we're getting real returns, okay, and risk is increasing. We need to go where the reward is acceptable. So DAX price has started adjusting, and so has the dollar price started adjusting. It's just one has started adjusting downwards, the other is adjusting upwards. Okay, and then we've got this big data point out tomorrow. So you can see that the interplay here between risk and reward is all encompassing. It's a chain of causality. Okay, let's take a look at the DAX a little bit in more detail. I want to just bring up trading view. Okay, so we go through to our weekly chart here. What we have is we have moved into zone 3. Okay, we have moved into zone 3. Take a look at the band, the Bollinger Bands, narrowed. Okay, but there's something else that's happening here, is that the narrowing, okay, has seemed to have concluded. Narrowing seems to have concluded because the bottom band is starting to pull away. So bottom band starting to pull away. In other words, we may be getting an expansion in that volatility. Now, let's go back here. Dollar, okay, has got a huge shift in gradient. DAX got a big reversal in gradient. And we go back to this chart over here. See that? The Bollinger starting to turn down, but the top Bollinger is still moving downwards. In other words, it's continuing in the bearish direction. It's continuing in the negative trend. The next leg to keep an eye on, stochastic. Stochastic, if that rolls over, okay, then I think we get the bottom Bollinger moving down, top Bollinger following us. Okay, what does that mean for us as traders? Go down to the hourly chart. Okay, the hourly chart is where we try and time it. It's a little bit easier to see the, I guess, the shorter term trades clearly on the hourly. So we've got angle and separation on our moving averages. We've got a very weak stochastic here. Now, clearly to get in here is going to be tricky. Why is it going to be tricky? It's going to be tricky because we've got a gap down on the open. Going into the Asian session, we've got a gap down here. Okay. If we hold the 20 area, I think we see DAX obviously weaken further. But in terms of getting in, there may be sort of getting a better risk-adjusted basis. So there's obviously a number of choices. Do you get in? Well, it's not breaking down already. Do I still have time to get in? Not sure. We still see a little, late over here. So perhaps worthwhile just keeping an eye on a better risk-adjusted. if you decide, well, I think the weakness is going to persist, just make sure that the stochastic stays below 20. If it doesn't stay below 20, then that weakness is actually starting to wane. Okay, and you can see that one level is holding for now. So perhaps just give it that hour to I guess filter through, get some sort of market direction. Again, a very good question here from Anna. How does the euro-US dollar affect the DAX? I would suggest there certainly is I think there would be a causality or causation. However, the fact that we're looking at the dollar in of itself, in my opinion, really takes care of that question, Anna, because let's add euro-US dollar as a third underneath us, because the US dollar is moving up. So if the US dollar is moving up, then it's quite likely euro's under pressure, right? So we just add that in. And we pop it in as the third chart. And let's put in our gradients. Let's put in our gradients. Now the gradients here are different to the trend lines in the DAX. Here we do get more of a negative correlation. We get a stronger negative correlation. So this is our red gradient. Let's make that red. Okay, let's get in the blue gradient. Okay. See that? Okay. Now let's put in the black gradient. And you can see just how much of a mirror image it actually is, isn't it? Now let's do the same exercise here. So let's put in the okay, so Anna's saying the euro is worth less, so it's more expensive for German companies to buy dollar-denominated goods. That might be true, Anna. That might be true, but it's not the whole. It's not the whole story. The weaker euro helps Germany's exports, and it's a massive exporting nation. So the yes, whilst the inputs probably are more expensive, it's only half of the equation. It's imports versus exports. What's the trade balance, right? Generally, a healthy trade balance should positively affect the okay, so she's saying the exports have actually gone down. So now that's a problem. So if the German exports have gone down and the imports are going up, that's a deterioration in what we call the terms of trade. I actually can't comment on that. I'll need to do some work, Anna, but the interaction needs to be between both of them. The interaction needs to be between both of them. Okay. So the idea here is, though, where's the cause and where's the effect? Okay. No worries, Howard. Welcome. Welcome. Where's the cause and where's the effect? Where's the cause and where's the effect? So I'm going to put out the I'm going to put out that it's the dollar the cause, and everything else I'm going to suggest is the effect. Okay, including DAX, including euro, they're all interlinked. They're all interlinked. So yeah, dollar moving up. Okay, that's our first link in the chain. Well then, automatically, Anna, there's your dollar-denominated problem with import costs. But then we've got an extra problem. Oil prices are up, and it's priced in dollars. Double whammy, double whammy. But that's not only Germany, right? That's global. That's globally, right? So the idea is, I guess, the Americans have the benefit of the stronger dollar. The rest of the world, not so much. Okay, so first movement. Let's call this first movement. Let's put in. Let's put in DAX underneath Euro US dollar. Let's keep DAX here. Let's put in at the bottom. Okay, let's put that in at the bottom. Let's make it the FXCM instrument. Okay, we'll put it at the bottom. All right, so a couple of things to do here. Let's make this logarithmic. There it is. Let's make this one logarithmic. And let's make this one logarithmic. Good. All right, let's go back to real rates first. Okay. Let's go back to real rates. Sorry, that's not what I wanted. We're going to do the inversion next. Let's just go back to, let's go over to real rates. Okay. Let's put in vertical. Oh, there it is. Okay. And so you can see with the euro, just as the dollar shifts from blue to black as we go positive, we've got the euro shifting from blue to black downwards, and that's because we've seen the rates go positive. At this stage, by the way, the DAX is already getting hurt, and that's probably a function of the high input prices. I haven't looked at German exports. If they're going down, the DAX would be feeding that as well, and that's possibly why we get the movement before. Let's take a look at the inversion now. Okay. All right, here's the inversion. Let's go to the first inversion. So that's where risk, this is where risk now starts kind of hitting hard. Now, what's interesting here, take a look. As we invert, so the DAX moving up just over 2-3 weeks, inverts, starts the next leg down. Inverts, weakness coming back in. Why would we have the weakness coming in here? Because prices have to make that adjustment. Why do prices have to make that adjustment? Because there is heightened risk. The longer we stay inverted, the more we're going to demand prices adjust. We're going to look for the right places to put our cash so that we're not exposed to risk that is not commensurate with the reward offered. So you can see this is what's happening in the market. Next piece of the puzzle, CPI tomorrow. Are we going to be higher than that headline 8.6%? That, in my opinion, is not good news, because I think it pushes the inversion deeper. Well, who knows what's going to happen to the gradient on the US dollar? And if the gradient on the US dollar moves, what's going to happen to gradient on the euro? And what's going to happen to the gradient on the DAX? Again, I'm going to stress, we'll carry on monitoring the COPOC. I'm of the opinion that COPOC is going to help us here. Very tricky environment, but you can see the complexities and how everything is acting very much in some sort of cause and effect linear fashion. All right, any questions around that? Please let me know, and I'll check on the trade balance there. It's a very good point, by the way. My my opinion would be that the adjustment in DAX, but not only DAX, adjustment in general prices very much need to be based on that type of a fundamental, very much. But I think that adjustment based on the very much part of that fundamental is exactly because risks are increasing. See, the risks are increasing. Why are risks increasing? Terms of trade might be deteriorating. Well, if terms of trade are deteriorating, risks increasing, I need a higher reward. But if I need a higher reward, price has to adjust. So that's kind of what is happening at the moment. And we're all looking for that bottom. But this inversion here, that I think is kind of now the focal point, because 75 basis points next week, if we get a heavy CPI tomorrow, possibly 75 basis points September, deeper inversion. Okay, we've already seen some cracks actually in the job market. Everyone is talking about the headline number beat. Yes, it did. Trajectory is down. It's coincident. Forward employment data looking very, very fragile at the moment. Yeah. All right. Any questions? Yeah, absolutely. So it's going to be a very interesting summit, to say the least, Anna. Absolutely. Let's wrap up here, guys. Let's wrap up here. You guys have my email address. I know there's a few outstandings. I will get to them. I'll put this onto our Telegram channel, and again, just give me pop me an email if you need to. Thanks very much, guys.